Tyler Crow. We're going to talk about Canoo just a little bit here. Canoo gets a ton of interest from people looking for like a lottery ticket, get rich quick, go to the moon sort of stock. At recent price, it was like 26 cents a share. Tyler, since you and I first started making videos about Canoo, at the beginning of the year, the stock price has fallen from around $1 a share, $1.20 a share, fallen to a quarter a share. At this point, we want to make a video talking about why investors who are looking to profit from the potential of EVs should move beyond trying to buy a penny stock lottery ticket and maybe focus on an undercovered opportunity and a way to invest in the future of EVs and the picks and shovels.
I can see Benjamin Graham's The Intelligent Investor, the definitive book of value investing. Hint, maybe I'll be using something from that book to talk about what we're doing here.
I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. Motley Fool's got its 10 best stocks to buy right now for you. You'll definitely want to check that out after watching this video. Again, let me do this, Tyler. Every time we do this, inevitably, we're going to get a bunch of comments. People are going to go and they're going to tweet at me and talk about how wrong we are and all the. I get it. I'm not talking to you, okay? If you're a firm believer in Canoo, there's nothing I'm going to be able to tell you that's going to change your belief. But this is a company that's already said they have a going concern statement that they issue in all of their, whenever they file a quarterly or annually report, basically saying they don't have enough capital to make it even a year. They just did something. They're raising another $21 million, selling stock at 39 cents a share. They're going to dilute everybody a whole lot more, continue to wash out value. They're really struggling to raise the capital to get their business up and running, okay? Unless you just like trading penny stocks and having fun, if you really want to make money, we have a better idea for you. Tyler, take it away.
All right, the Canoos of the world, the workhorse groups, the myriad of other speculative EV companies, they're speculative for a reason. They're not profitable businesses. They haven't proven that what they do is going to make money over the long term. But that doesn't, just because those particular companies might make it, might not, doesn't necessarily make them investments. They're speculative ideas. So I want to transition to investment ideas of proven companies that make money, that have good returns on capital, and are mispriced assets. This is where, like I was saying, value investing, ideas that are misunderstood and mispriced in the market right now. And one company, I think, that is we can call it a picks and shovels play, to, if you will, to the automotive industry. It's called Ternium. This is, I know if for people who watch this a little bit, I'm always the one who goes to weird places. So I'm going to talk about an Argentinian steel company. Eye rolls already begin. But Ternium isn't just an Argentinian steel company. They are the largest steel manufacturer in Latin America. And if we can include the United States, they're the number 3 in the Western Hemisphere, behind Nucor and Cleveland-Cliffs. The vast majority, more than 50% of their actual steel production and steel sales is in Mexico, with a very large correlation to the automotive market. And if you see what is happening in Mexico in terms of automotive manufacturing, Ternium is basically leveraging a lot of what they do to serve the automotive market and industrial manufacturing in Mexico, specifically from what you would call I would call it the crown jewel of its entire operating facilities. You can see that cluster of about 9 dots in northern Mexico. That is it's the area called Nuevo León, around the Monterrey area. This is the manufacturing hub, especially in automotive, for Mexico. And Ternium has a massive industrial complex there, and they're currently investing about $3.2 billion over the next 4 years into this particular area. They're adding a new electric arc furnace. They're doing hot dipped galvanization lines, and basically all of the things that you need to build out construction, as well as make automotive grade steel for the Mexican market. Now, this is, like I said, this is their big growth pipeline, but it's also just a decent business that makes double-digit returns on capital. It's been doing it for a long time. It has more cash than debt right now. So I think right now about 25% of its net cash position, meaning like if you pay out its debt and just the cash left over, that's a 25% of its entire stock price right now. and it currently trades for a 0.6 times tangible book. Now, somebody might say there's some weird or unconventional ownership of the company because 75% of it is owned by the founding family back in 1945, the Rocca family from Italy. You might say, oh, there's such a low float, that could be an issue. Founders that own a lot of the company trading for a deep discount, and clearly they want the lasting per share value of this business to grow. That seems like a pretty winning idea that is, I would say, tangentially related to automotive because they're making such large investments in that particular part of the market.
Let's talk about a couple of things here. So, number one, steel industry is really challenging. The steel makers that win are the ones that build cost advantages, build scale advantages. You don't have pricing power in steel unless you have a very specific product that you're the only provider of, and it's a high value add product. You have to have cost advantages, and that comes from scale and logistically being close to your buyer because that cuts down shipping costs. And those are some things that Ternium clearly has built. And you also want to think about tailwinds too, Tyler. That's really important when you're thinking about these big heavy industries. And on our podcast, we had Bill Mann on a few months ago. And Bill Mann, for those that don't know, is a very established international investor, spent the past 30 years focusing on a lot of international markets. And he specifically called out Mexico as one of the most important international markets over the next 20 years. I think it's really interesting. You're talking about a steelmaker that's in Mexico, that's a core part of their business and a growing part of their business is right exactly this area that Bill talked about. Plus, you think about the trade agreements between the North American countries and how important Mexico is becoming. It's a big part, it's telling. That's directly related to exactly what you're talking about here. So I do have a couple of questions I'd love for you to answer for me. Thinking about that discount to book value, thinking about this business looking forward, how much of this is just a deep value play versus thinking about this as the long-term growth opportunity?
I lean towards the deep value opportunity more than others. Like I said, steel is never going to be a business that trades for a steep premium. You even look at a company like Nucor right now, as wonderful of a business as that has been a wealth compounder. I still think that it trades in a price to earnings somewhere in the single digits right now. And that's just the nature of how cyclical stocks are. But even businesses like that will trade with a price to tangible book well over 1 times. So at a 0.6 times tangible book value, I look at this as just a deep value play with some long-term catalysts built in terms of growing that Mexican steel production.